People think the markets, I need to keep making my model complex to generate returns. It's really not like that. Sometimes the simplest of information that you read can generate the best results. So whenever you read or understand fundamental analysis, try and do it with an open mind and keep things simple.
Hello and welcome back to Paisa Bolta Hai. This is Mridanjali Raval. Our today's guest is Roshan V, who will talk about quant and fundamental analysis. Don't worry, we'll keep it lively. Hi Roshan, thank you so much for joining us on Paisa Bolta Hai. How are you doing today?
I'm doing well. How are you doing?
I'm doing great. It's awesome to have you here. So let's start with today's conversation. Please introduce yourself for our viewers and explain your role as a quantitative research analyst in the Indian stock market.
So, hi everyone. My name is Roshan, and I work as a quantitative and fundamental research analyst. And my role involves picking up stocks on the basis of mathematical principles and financial principles, in short.
So tell us about how did you find your way in this specialized field? How's your journey like?
Okay. So I started off by studying the principles of financial management and then moved into understanding technical analysis properly. So that was my first step because 10 years ago, 9 or 10 years ago, there wasn't much information available in the market, and I had to search for certain books and videos and whatever else I could to understand principles of the market. And it primarily came from Warren Buffett's Intelligent Investor, not for technical analysis, but I'm just talking about books related to investing. Post that, I did a degree in statistics. So once I did technical analysis, I understood that the markets needed little more complexity. So I layered it with statistics and understanding risk management. So one of the things that I saw traders consistently do in the markets here is get very excited, emotional, and not understand principles of risk management.
Yes.
So I understood those principles using statistics and risk management, and then moved into CFA, which I'm still doing. So understanding these principles in a sequential manner helps you become a better trader and a better investor.
You mentioned technical analysis 2-3 times in the last answer.
Okay.
In one liner, would you like to explain for our viewers what technical analysis exactly is?
Perfect. I'll go one step further. I started with technicals, moved on to fundamentals, and then quants. So I'll just talk about that progression. So technical analysis is very simply reading chart patterns and and price action. So you have chart patterns and price action marrying each other and then generating strategies. So you have concepts like RSI, moving averages, the flag when it comes to chart patterns, and those generating, I mean, that's just a simple example, but a combination of these result in your final strategy. When I talk about fundamental analysis, according to me, that's the next step, because you're understanding the company at the root level. You're understanding what's going on in balance sheets, cash flow statements, income statements, and then generating future valuations. So a technical analyst who knows fundamental analysis can marry the principles of price action with the accounting statements and management commentary, etc., and future prospects of a company, and then generate results. So they are more robust. Where quantitative analysis comes in is you discover relationships that these two principles cannot discover. So it becomes even more robust. And quantitative analysis is used a lot by options traders, because it's it's easier to use math and trade options there. You can't use technical analysis there. It fades away. But with
Interesting.
stocks, currencies, a lot of other principles also apply.
So tell us about what are some key types of data that you analyze and how does this data help you make informed investment decisions?
Okay, so one of the main things that I analyze are ratios. Okay, within a particular company. Before going into technical analysis, what I do right now is understand ratios, and I read a lot of annual reports, segments of annual reports, because going through everything might be extremely time consuming. So I try and understand segments like management commentary. What does the management think about future prospects? So once you have a framework, so I'll just take an example. The best type of car to buy now is an EV. Why? Because the government might scrap other vehicles, right?
Right.
So what I did 3 years ago, there was a company called Electra. Okay, so they're based in Hyderabad and they're into electric buses. I just read a simple piece of information that the government there might help them. So that was a more macro policy level decision of the government. They got a tender, and once the management accepted the tender, and that comes into the balance your annual reports. Once you read that, your balance sheet and annual statements, and they're not going to reflect that immediately. You have to be prudent enough to say they're going to get orders in the future, and they might have great valuation prospects in the future. You then go and look at price action. What's it trading at? It was trading at something around 64 3 years ago, October 2020, if I'm not wrong. It was trading at around 64. So that gives you a sense that, okay, this stock seems cheap right now. And how do you arrive at that decision? Because you think that there's going to be momentum in the stock in the future. You apply these principles, and then you arrive at a decision that, okay, it might be a good buy, and today the stock is at 1200. So this is the process that I follow with everything. I understand the macro picture, go back into the accounting statements, look at the price action, and then decide whether to buy a stock by applying certain principles. Another interesting stock, let's talk about the sector first, the railway sector, right? So if you notice, during inflationary times, spending power comes down, right? Because time, your money is losing value.
Yeah.
And you can see people complaining about inflation all across.
Yes.
So if you notice, what did the government do that time? They started financing the railway sector even more. So if you look at all the railway stocks, IRFC, Indian Rail Finance Corporation, it's gone up from 35 to 50 now. RVNL went from 30 to 140.
Wow.
And all this was just based on, people tend to complicate the market, but sometimes just by reading the fact that inflationary pressures are going to force the government to increase interconnectivity using railways and expand that network even more and electrify it so that it becomes more productive when they buy the wagons.
Right.
That helps you understand that there's going to be fund flow into that, and the government tenders are going to push prices up. So you have Titagar Wagon Wheels, RVNL, IRFC, all these are railway stocks. So what I did was, you don't need to overthink every single decision, right? So all I did was, my allocation to railways, let's assume, would be 10% of my portfolio because I see the sector doing well.
Wow.
And then if I'm allocating 10%, you just buy 3 to 4 stocks there. You're sure to get some sort of returns because railways provides automatic diversification in your portfolio. It manages downside risk. And on top of that, these are heavy dividend payers. So it's completely secure. IRFC has extremely good dividend yields. Forgot the exact number, but the dividend yields that you get on average, even if the stock goes down by 10-20%, you'll recover that.
Yeah.
So you're kind of protected on the downside because of dividends. There's only upside because of tenders and these kind of the kind of push that the government gave to the sector, and it all played out in the span of a year and a half.
That's a very interesting insight. Another insight is railways is a very good sector to invest in. So I'm going to go back and maybe
I don't know if it's a good sector now.
I'll do some research. Research and then I'll get into it for sure.
Yeah.
Okay, awesome. Lot of beginners, when they start investing, there are a lot of misconceptions that they are around, we meet, like especially it starts with the family. There is a taboo around investing in stock market. So how do you as a professional address these misconceptions?
That's a very good question, because there's a misconception that markets will make you lose money, because the first reason people put money into the markets is to make money quickly.
Right.
So misconceptions arise from there, because one person will greed is a great emotion, right? So one person will say, you can put 10,000 in the markets, and that's how scam calls come as well. Put 10,000 in the market.
Instant returns.
Yeah, instant returns. Within 2 days, I'll make it 20,000. So when I used to get these scam calls, I was like, why are you even marketing? You should do this with your own money. Like if you do this over the span of a month, you will become like, you'll already make 20 lakhs from 10,000. You shouldn't be wasting time by calling me itself. So what ends up happening is there are two sides of the market. When I'm buying, someone else is selling to me. Any stock that someone else is selling is being bought by me. If I have 2000 retailers going around and spreading that money can be made fast, and imagine these 2000 retailers have connected with 10 other people, their family members or friends. Okay, so let's say they've connected with 10, that's 20,000. All these 20,000 people are now pushing up the prices
Right.
of any stock. Institutional investors understand these patterns, and now with machine learning, etc., you can decipher these patterns even better. So you'll keep pushing the price up, you'll hit the peak. And I think the word going around now is the same, right? Will the market say 20,000? Is it going to crash? Every risk, whenever we think that it's going to crash, it hasn't in the past few months. But this is exactly what institutional investors do. They push the prices up, sell it to retailers, and then when it crashes, you won't have time to get out. That's because another mistake that retailers do is, suppose a stock has gone from 10 to 200, they would have bought it at 200 because the stock is going up. Someone has told them the stock is really good,
Right.
but it has already gone up so much. If you get in at 200 and then let's assume that it comes down 20%, they don't sell it, they'll buy more. They'll be like, it'll come up, I'll buy it at 180, it'll go to 140, they won't give up, I'll buy more at 140. Ultimately, if that stock goes to 50, I'll be holding like 1 lakh worth of shares with a 50% loss on
Yeah.
average. So this is another mistake that people do. They don't like giving up their stock. I have a friend who does this as well. Uh, Holds on to stocks over 3 years and finally waits for a 5% profit to sell it. Like over 3 years, you've lost so much money, you should have taken it out at a loss and put it in some other stock. But no, they'll wait till they see 2% in that stock.
Yeah, it's so interesting. I have not bought like this, but I bought a share. It was performing brilliant, like last 10-15 days, great performance. And I bought it. And since then it's down. It's a very small amount of money. I think I'll still wait because it's a big company. I know for the fact it will come up in a month
You know for
or
a
two.
fact that it will come up.
That's my analysis as
You
of
should tell
now.
me about this stock too. No, I'm just kidding. But
Yeah, I get it. How do you stay up to date with the market changes and ensure that your models remain relevant? Like, apart from the fact that you follow news and company reports, which are like on regular basis, what other advice would you like to give to our viewers?
Okay, so I actually love this question because in developing a strategy or whatever you do in the markets, your models you need to have one framework that you follow, and you keep tweaking that particular framework to adapt to different market conditions and changes, right? So what I do, I follow a similar system, and if it doesn't work or if I can add something to make it better, I do that, which is why I'm still learning. I'm not an expert in MLAI. How do I stay updated with the trend? I wake up very early. I wake up at around 5 every day, 5:30, and that helps me read. So every morning, I remember the early days. I was very excited for the Nikkei. The Japanese markets open at around 6 a.m. I used to start reading about the markets, from 6 a.m. And back then, I was very excited about Dow Jones closing, this one opening. But then I realized it's about how much information you extract. And then, as in when you read, you will know what to read as well. What I would say is read the news. Don't ever skip that, because that's what gives you intuitive power, and then you can keep updating yourself, your skill sets, and keep improving your models.
It's a very good advice. Thank you so much. If you could give one piece of advice to beginners who are intrigued by the idea of quantitative plus fundamental analysis in the stock market, what would that be?
Don't overcomplicate models. The most complex model is not necessarily the best one, and I think this has also been said before. People think the markets. I need to keep making my model complex to generate returns. It's really not like that. Sometimes the simplest of information that you read can generate the best results. So whenever you read or understand fundamental analysis, try and do it with an open mind and keep things simple. Same thing for quantitative analysis. You don't need to be the best statistician in the world, understand every single formula, because even when I open a book now, it's not that I remember all the proofs, what's going on in the math. As long as I can keep things simple, I can generate returns, and make it complex only when you need to make it complex.
Okay, awesome.
Yeah.
So these were the questions. We have a last segment called rapid fire. I'm sure you're aware about the rapid fire. It's very popular.
Oh yeah.
Yeah, I'll ask you 3 questions, and you have to answer it quickly.
Okay.
Okay, let's start. Name 2 stock market books you recommend.
So The Man Who Solved the Markets by Jim Simmons and Intelligent Investor.
Name 3 stock market influencers you admire.
Nikhil Kamath, Saurabh Mukherjee, and Rakesh Jhunjhunwala.
Name the most important trait required for the stock market success.
I think controlling your emotions, also not getting your emotions home. Like, you have a family, I think you should keep that. You have a girlfriend, family, whatever it is, don't take out all the emotions there.
Thanks so much. It was a great episode. It was great to have you here with us, Roshan. Thank you so much for joining us today.
Thank you so much. I had a lot of fun.
Awesome. Thanks.
Hi, folks. My name is Roshan, and I'm a SEBI registered RA. I joined StockGro a few months ago, and the reason I joined StockGro is you have a lot of platforms out there: Facebook, Instagram, Twitter, where you can publish your research, but you get a lot of comments, you get a lot of unnecessary comments, you get a lot of users, and it's not really controlled. But StockGro, it helps you create that framework. It helps you get in users who are a little more serious about investing, or at least want to learn something about investing. So, as a research analyst, I don't want to get abused on platforms. I would like getting criticized or critiqued, and that's where StockGro helps. It helped me build an audience. It helped me connect with a wider set of people in just a few months. And publishing my research there gives me an environment where I can choose whether to respond, I can take in comments and improve myself. So, thank you so much for the experience, and I hope it keeps growing.
Thank you, Roshan, for talking about the world of quantitative and fundamental analysis. To the viewers of StockGro, until then, keep learning and investing wisely.